It's one of the richest nations in the world, but Norway's government has lowered its growth forecast for mainland GDP from 2.5% to 1.9%. For decades, Norway has enjoyed the boost brought by black gold. But can this continue? For Dukascopy TV, I'm Sophia Aribo. With me to give his insight on the Norwegian economy is Swedbank's Harald Magnus Andreassen. Harald Magnus, a government-appointed committee says that lower demand from the oil sector will knock off an average 0.4% from GDP for more than 20 years. Are we seeing the beginning of the end of Norway's oil-fueled economic boom?
Quite likely. We have already seen now that oil investments might be peaking in this cycle. I don't expect a huge downturn short term, and it will take a very long time before oil investments come down to zero. And I think the 0.4 reduction in GDP growth over 20 years is a bit exaggerated, in fact. If you compare to other changes in the economy, this is not at all dramatic. But still, we have had a huge support from growing investments, and that support is now waning.
The latest OECD report on Norway highlights the housing market as a factor that could threaten Norway's economy. It also states household debt is still high, on average 200% of disposable income. How big a threat are these factors?
Substantial. House prices are high, debt levels are high. At one stage, the cycle might turn. However, households have debt, but still they have a quite high savings rate, and that's not usual following such an increase in debt and high house prices. So the consequences for the rest of the economy will be less than normal if house prices one day should fall. I expect that to happen, but it might happen gradually. Last time we had a huge problem in the Norwegian housing market back in the end of the 80s, beginning of the 90s. We had interest rate at 12 to 15%. This time, of course, interest rates will be very low. So the debt hangover will be easy to manage for most households.
Norway's biggest banks have been ordered to increase their capital buffers with, according to some, tougher capital requirements than the ones demanded by EU regulators. What do you think is behind this move?
The capital requirements are not tougher than what they should be according to EU regulations. But sure, the Norwegian economy has been in a more booming state than the European economy, and debt levels are still increasing. So that's why capital requirements are higher in Norway than in most countries in Europe. I think this move has been a smart one. We need to calm down credit growth, and I guess that those capital requirements contributed to a slowdown at least last year. Now it seems like banks are satisfied with their increasing capital and are becoming more aggressive in the lending market again.
Thanks for your analysis, Harald Magnus. For an interview on UK GDP data, be sure to check out Ben Jones on Thursday.